I'd just like to highlight what we think are the key points of our philosophy and really their competitive advantages in our minds. And I'd start at the top left corner there, concentration. All of our strategies are concentrated, including the global growth strategy that we're here to talk about today. We own about 25 to 30 of the best companies in the world in the global portfolio. And we think concentration is advantage from a couple points of view. One, the obvious is when you're concentrated in the highest quality, higher growth companies, that differential of growth over time is what's driving that differential return profile. That's how we're able to add excess returns or alpha. Just as importantly, if not more important, we believe we can actually reduce risk through concentration. And that's probably the less intuitive piece. Many people hear the word concentration and think riskier. In fact, our portfolios for more than 30 years have delivered less volatility, captured less of the downside in the market, while still delivering very strong returns over the long term. Now, global doesn't enjoy that 30+ year record of our US strategy, but we've already had a pretty interesting 6.25 years since we launched this strategy. And we see the same earmarks that we've seen throughout our longer history with the US strategy. What I mean by that is in 2015, when the MSCI was down, our global growth strategy was up nearly 10%. 2018, when pretty much every index, equity or otherwise, was down, and the MSCI was down almost 10%, our global growth strategy was up more than 2%. And then again, at the beginning of 2020, another quite interesting year, as the market was declining during the peak of the coronavirus or the pandemic fear, our portfolio only captured about 60% of that downside, recaptured the upside as the market recovered through the second and third quarter. We did give up a little bit of ground in the fourth quarter and into the first quarter of 2021, as we saw a strong rotation towards cyclicals and some more value-oriented businesses. But during the whole of 2020, we outperformed by a nice margin. Again, just reflecting the safety and quality that complements the growth profile that comes with that over time. And then I'd also highlight that our long-term holding period is a real advantage as well. We're not trying to tactically trade or create returns through activities. What we're trying to do is construct best-in-class portfolios, own businesses for the long term, and let the underlying earnings growth of the companies in the aggregate portfolio drive our returns. So we're trying to get to mid-teens underlying earnings growth with the expectation that will drive the return profile over time. Since inception of Global, that's exactly what's happened. We've compounded at a little more than 16%, and that's been supported by strong double-digit underlying earnings per share growth in the portfolio. And as David mentioned at the outset, we do all of that with a low turnover approach. From a risk management perspective, I think we also have an advantage in the way we put it all together. One, there's a very high bar to even get into our portfolio. The companies that we're considering are exceptional businesses, and Jeff's going to unpack that as he takes you through the process. But I think by setting a really high bar, we remove a lot of risk at the front end of the process. And then we're also very quick to get out of the way if a business is being threatened, the competitive advantage is eroding, or we see a new risk emerge. And then finally, as it relates to global investing, when you go abroad and invest across geographies, we have to take into consideration country, currency, other types of risks that come into play. I'd just note for you that in our global portfolio, there is a notable bias towards globally competitive and globally dominant businesses. They sound like simple words, but there's very strong, profound effects underneath of that. If not only are we looking for businesses that sell differentiated products or offer differentiated services, they're doing that not just in one country, but most times in 20, 50, 150 countries around the world, which is quite a feat in rarefied air. And then the final thing I would note is, roughly 90% of our portfolio is either earning in the US dollar or a broad basket of strong currencies. So we're not taking on a lot of currency risk. The only exceptions there would be Tencent and Alibaba, which are earning almost predominantly in the RMB. And we're certainly happy to address how we think through the possible implications of currency in some of those situations. Then the final thing I'd like to highlight is just the outcome orientation. We're actually more of a absolute return mentality as opposed to a relative mentality. We're really trying to drive double-digit returns for our clients over time while taking less risk. We've been very successful over the past 30 years at delivering on that, very successful since the inception of Global delivering that, and we're quite confident based on our investment application that we can achieve that going forward as well.